today. It'll be announced from 3:30 p.m. And a lot of experts and analysts are expecting a heavy emphasis on tax this year.
Yes, indeed. From GST to carbon taxes, even our wealth taxes, changes are expected to be announced at this year's budget. But today, in our exclusive conversation with KPMG, we turn our focus to how Singapore can harness global tax opportunities.
So, as Singapore prepares for new international tax rules, there is room to consider how fiscal tools should be introduced to attract and anchor businesses here, while at the same time scope out the effectiveness of current and future tax incentives.
So the question is, what are KPMG's propositions for Singapore to do this well, and how can we seamlessly adapt to the changing tax landscape while creating jobs and increasing competitiveness as well?
On the line with us this morning is Mark Addy, partner, energy and natural resources, telecommunications, media and technology, tax, KPMG in Singapore. Mark, good morning. How are you?
Good morning. Very well, thank you, Elliot.
Very good, sir. Thank you so much for helping us out. Let's start off by talking about the OECD, or the Organization for Economic Cooperation and Development, and the G20 Inclusive Framework on BEPS. Now, they've agreed to reform existing international tax rules, and the agreement sets the key terms for a two-pillar approach. Mark, to sort of set the tone for this conversation, could you help give us a quick overview of the changes that have been agreed upon?
Yeah, sure. So, I mean, as I'm sure you've probably seen over the past 1 to 2 years, this has generated an awful lot of headlines in the business press, something that governments are very interested in. And essentially, there's two overriding objectives in terms of the reforms to global taxation. One is to try and improve the fairness of the global tax system, or the perceived fairness. And the other is going some way to removing tax as a competitive tool for countries to use. Now, this is split into two pillars that you mentioned. The first pillar is focused on the very large multinationals, so those that have turnover of more than 20 billion euros. And this essentially is a significant departure from the international tax rules that we've been familiar with for the past 100 years. It's now moving away from this idea that you need to have a physical presence in a country to be taxed in that country. So you can see that this is a big change. Pillar 2, which has probably grabbed more of the headlines, is a global minimum tax rate of 15%. So essentially what it's saying is that all multinationals, no matter who you are, if your revenue is more than 750 million euros, you will be paying a minimum tax of 15%.
The thing is, Mark, what do we need to watch out for when it comes to interaction of the new rules with US tax reforms? I'm sure that will have an impact on how Singapore operates as well.
Yeah, so the US actually has a similar rule in operation at the moment called GILTI, which is an acronym for Global Intangible Low Taxed Income. Now, this is not completely aligned with the BEPS rules. There is some expectation under Biden's tax reform proposals that they will align this with the BEPS proposals. If they don't do that, that potentially has an impact on US multinationals that are operating in Singapore and other countries, because it could mean that they are paying additional taxes under the GILTI rules, but also under the BEPS rules.
Naturally, it's a case of issue and opportunity that arises when you have these new international tax rules. Mark, how do you think this is going to affect Singapore's current offer of tax incentives?
Well, I think this is one area that has generated a reasonable amount of concern in Singapore. So, and the best way to explain this is probably through an example. So if you have a Singapore company which is paying tax, has an incentive tax rate of 10%, what the Pillar 2 rules are now saying is that that will be topped up to 15%. Either in Singapore or another country will be able to tax that profit at 15%. Now, what we believe at KPMG is that we need to have a re-look at the incentive regime in Singapore and find new ways to incentivize businesses. Now, clearly, there are a lot of companies in Singapore that will benefit from incentives, and it may be that those incentives are not as beneficial as they once were. But there are other ways in which companies can be incentivized to move to Singapore. We know Singapore has a lot of non-tax advantages, and there are ways within the rules that Singapore can incentivize companies without being caught by the Pillar 2 proposals.
Could you expand on some of those ways? What do you have in mind?
Yeah, so I think one of them really is to focus on, so we want Singapore to be a research and development hub, an innovation hub. Currently, there are rules which provide for enhanced tax deductions if you're performing innovative activities in Singapore. So if you're performing research and development, for example, you're entitled to enhanced deductions. You can shift that around. So instead of providing an enhanced deduction, you can provide a tax credit. And what that basically means is that instead of a deduction, you are giving a cash grant to a company for performing the research and development. And there are countries around the world that already have these systems in place. It's effectively giving the taxpayer the same benefit. It's just shifting it around so that instead of a deduction, you're giving them a cash grant to incentivize the R&D being carried out in Singapore.
So KPMG is suggesting to replace the existing R&D enhanced tax deductions with a refundable R&D tax credits scheme. Expand a little bit on this for us and tell us how this is going to work in Singapore's favor.
So this will work. So the rules currently, when you calculate your effective tax rate for the purpose of the global tax rules, it's based on a standardized approach across all jurisdictions. Now, the issue with that is that all jurisdictions have different tax rules in place as to how they calculate their taxable profit. Okay. If you have an enhanced deduction, it's likely that for the purpose of calculating your global tax, that will be disregarded. So we need to relook at that. And if we make it a credit, so an R&D grant or a refundable credit, that potentially is not caught by the rules, so it doesn't affect your effective tax rate and means that you are more likely to not have to pay a top-up tax in another jurisdiction.
Give us some examples of how European countries have done this well and what we can emulate here in Singapore.
So this is quite commonly used in a lot of European countries. So I think the UK, Ireland both have similar systems. Australia and Canada also have systems in place for R&D tax credits. Now, it's not that they've been doing something particularly well. It's just that it's another way of incentivizing a company. Historically, Singapore has had one of the most generous R&D tax incentive schemes and has been very successful at encouraging companies to locate in Singapore and bring their innovative activities. It's just simply now the fact that these rules would potentially penalize you for enhanced tax deductions, which is why there's a need to shift towards an R&D tax credit scheme, similar to what we see in a lot of European countries and Australia and Canada.
All right. Up next, we're going to bring a traffic update. But before that, Mark, let's wrap up this segment by talking about our existing M&A allowance scheme. Where does KPMG see that it can be enhanced or expanded?
Well, I think the first thing to say on that is that the M&A allowance is a very generous scheme. It provides you with tax deductions for making significant investments, but basically buying shares in other companies. Where we think this can be enhanced in future to continue to encourage companies to basically enter into strategic alliances in Singapore. We're seeing a big trend of companies wanting to enter into strategic alliances, to combine their technologies, to make their offerings more compelling to the market. By including strategic alliances, JVs within the M&A tax allowance scheme, we think we can enhance that and encourage them to structure those arrangements through Singapore.
We're speaking with Mark Addy, Partner, Energy and Natural Resources, Telecommunications, Media and Technology Tax at KPMG in Singapore, looking ahead to Budget 2022 and what we can expect in terms of taxation changes. Stay with us. We'll continue in just a moment.
The Breakfast Huddle with Elliot Danker, Bharati Jagdish, and finance presenter Ryan Huang. Only on Money FM 89.3. Traffic.
8:16. Good morning. On the roads, heavy traffic at all the usual spots. AYE towards the MCE. There's a vehicle breakdown after Pioneer Road North. ECP towards Changi Airport. A vehicle breakdown after Bayshore, trying to avoid lane 3. And on the PIE towards Changi Airport, a vehicle breakdown after the BKE. Drive safely.
If you see anything on the roads that we might have missed, you can share it with us via SMS or WhatsApp at 8855-0893. But please send the message through only when you are safely parked. Money FM Budget Conversations 2022.
As a first-time buyer, I was glad to see the recent property cooling measures, but I'm actually not sure if they will bring the prices down.
Your voice.
So I'm quite worried property prices will still continue to go up.
The pandemic has put the healthcare sector under tremendous pressure.
Your thoughts.
So I'm worried about how much taking care of my parents will cost me, and I still have my own family and children to worry about.
About any new green policies.
Your needs.
And also level the playing field for the less fortunate.
Presented by UOB in partnership with KPMG and REACH UOB, forging a sustainable future for the better of ASEAN, for the better of all. The Breakfast Huddle with Elliot Danker, Bharati Jagdish, and finance presenter Ryan Huang. Only on Money FM 89.3.
Budget Review brought to you by KPMG, shaping lasting companies and communities for tomorrow, today.
Money FM 89.3. Good morning. It's the Breakfast Huddle with Elliot Danka, Bharati Jagdish, and Ryan Huang. We are looking ahead to Budget 2022, which will be announced this afternoon, the 18th of February, at 3:30 p.m. And right now, we're talking about some of KPMG's proposals ahead of that budget announcement. On the line with us is Mark Addy, partner, Energy and Natural Resources, Telecommunications, Media and Technology, Tax, KPMG in Singapore. Let's take a look at this next proposal that KPMG has. It's about enhancing a regional HQ incentive for multinationals. Mark, KPMG is suggesting grants to encourage investments to transform the regional HQ functions. Why do you guys at KPMG see the need to put emphasis on this, Mark?
Well, this actually comes back to what we were talking about earlier in relation to if you offer a lower incentive tax rate, that potentially gets caught by the Pillar 2 rules and you have to pay a top-up tax in another country. And the last thing we want another jurisdiction. So by offering grants instead of lower tax rates, you effectively give the same benefits to companies, but potentially you don't get caught by those global tax rules. So that's why we think there's a need to shift the emphasis of tax incentives to grant-based incentives rather than tax rate-based incentives.
Tell us more specifically how these grants could help MNCs transform their HQ functions, Mark.
Well, it's a good question. I think what we want to do is see that the grants are focused on certain areas. So we know that there is a big push for innovation, for automation, for adoption of artificial intelligence solutions. So by directing grant funding into these kind of areas, you can attract companies into Singapore who will then adopt these technologies and overall just improve the technological space in Singapore.
Mark, a couple of issues sort of overlapping here. On one hand, you have Singapore trying to strengthen its position as a global hub for businesses. On the other, there's this whole thing about hybrid work becoming the norm. You're working from home right now. What should authorities consider, and why should authorities consider employees outside of Singapore as full-time employees in evaluating whether a company meets the incentive milestone commitment? Can this even be done?
Yeah, it's a good question. It's not a straightforward area, but as we've seen in the past, certainly 1 year to 18 months, there is a huge push now among companies to allow their employees to work. And on occasion, that means being able to work in a different jurisdiction to the one in which they are employed. So if Singapore can be the front runner in this area and start offering incentives for companies that maybe have employees that are temporarily based outside of Singapore, so that want to spend a few months of the year outside of Singapore, then that can be a way of really attracting high caliber people into Singapore by offering them that flexibility. Now, it does come with various tax complications, and they need to be worked through, but Singapore can really be the forefront of this and start to release guidance around how it will treat such situations and use that as a way, like I said, to attract high caliber individuals into Singapore. And what I would say, and we've talked a lot about how Singapore will be impacted by these changes to the global tax rules. We do believe at KPMG that Singapore is in a very strong position to thrive on the whole reform to global tax rules, because not only, I mean, we speak to C-level executives regularly among our clients, and while tax is one of the key reasons that they give for moving to Singapore, there's a huge range of other reasons that companies locate in Singapore. You know, we have a stable economic and political environment here. We have access to an incredibly skilled workforce. So there's a number of factors, and really what we're suggesting here is just finding ways to tweak the current to give that additional tax-related incentive to come into Singapore. But on an overall basis, we really think Singapore is well positioned to thrive in the future global tax rules.
You talk about incentives, and among the other incentives you're proposing is the Factory of the Future incentive related to the local manufacturing space, global realignment of supply chains, of course, attributed to global tax changes as well. Tell us more about this particular incentive.
Yeah, so again, this is really part of the journey to the adoption of smart technologies and the high tech adoption and automation of processes in Singapore. So essentially, this is trying to attract high value product manufacturing into Singapore. It was mentioned earlier on the program about ESG and the impact of carbon emissions, and this all links to making factories more efficient, making sure that they have technologies that are not producing the same sort of carbon emissions. So this can all be linked in with the push towards carbon neutrality that Singapore is obviously on board with and is really trying to push for. So this forms part of the incentives that we would like to see in relation to, first of all, improving automation in Singapore's manufacturing facilities, but also making sure that that is aligned with Singapore's ESG objectives and bringing Singapore to a carbon neutral position as quickly as possible.
Mark, I can practically hear drivers in their cars saying, then give us a grant. Do you have any grants that could be suggested?
Well, I think on the carbon taxation side, one thing that we would like to see is more encouragement for the adoption of electric vehicles. Now that could take the form of reduction in customs duties on import of electric vehicles, for example. It could be an improvement to the infrastructure related to electric vehicles, so more charging stations, and basically just improving accessibility. Now, there's a number of other ways in which you can do this. You can look at properties, for example, as a starting point and offer incentives to property owners to make their buildings more efficient. But overall, this is all part of the raft of incentives that we want to see in relation to the ESG space, which also links to making Singapore attractive as a global and regional hub as well.
Mark, I'm sure there's scope to boost non-tax incentives as well, right? Tell us more about that approach.
Yes, and I think this is a key area because we've talked a lot about the impact of Pillar 2 and how the tax rate now globally will be 15%. So if you have a reduced tax rate in Singapore, you are paying the top-up tax somewhere else. So the focus really needs to shift to non-tax incentives and finding out why companies really want to locate in Singapore. And one thing we can tap into here is the fact that when you speak to business leaders, the tax does not drive the business, the commercial factors drive the business. So if you have a US or a European multinational that wants to set up in Asia Pacific, they're not just setting up in Singapore for tax reasons, they're setting up here because it's the best place to run your Asia Pacific business from in the region. Now, we need to focus around these. So one example of that could be, encouraging stronger coordination between some of the Singapore government agencies. So we've got really good economic agencies that will work to attract those investments, linking those in with the Ministry of Manpower, with the IRS, to make it much easier for, the kind of teething problems that we see whenever you set up a company in another country.
And the timing couldn't be more important because Singapore's put itself on the map with regard to how it's dealt with the COVID-19 pandemic. It's still being, scrutinized. Any comments on timing moving forward as the world is trying to get behind this COVID-19 pandemic?
Yeah, I think in the context of tax incentives, I think it's unlikely that we will see significant announcements in today's budget. The global tax rules were announced just before Christmas. So tax professionals, and I'm sure the government, have had very little time to absorb these. We're still waiting for detailed guidance around the rules. So I'd be surprised if we saw significant announcements in today's budget in relation to that. But I do think it is something that is at the front of mind of the Ministry of Finance and of the government generally as to how they will address some of the issues that Singapore will face under these rules and shift the focus of its incentives to non-tax incentives, but also those companies that fall below the thresholds, because 750 million euros is a significant amount of turnover. There are lots of startup companies that fall well below that and that are growing very quickly. So one thing that Singapore can look to do is shift the focus to say, look, we're going to focus on fast-growing companies, high-tech, high-growth companies, try to get them into Singapore to carry out their innovation and research and development activities. Once they're here, then they may exceed the threshold later on, but you've got them in Singapore as a key location in their supply chain. So that's one of the shift in focus. But I think the key messages really are that Singapore is well placed to thrive under the new tax rules. It needs to focus on just making sure it enhances its competitiveness. So looking at R&D grants, the M&A allowances that we talked about. re-looking at its incentive regime so that we have an easily understood and simplified regime, and that focus can shift to smaller groups, so you effectively get them in the door. And then again, so boosting and focusing on the non-tax incentives, making sure that we continue to be business friendly, and that we really link up all those agencies to make the entrance into Singapore as seamless as possible.
Thanks for summing that up so comprehensively, Mark. Really appreciate your time today. We've been speaking with Mark Addy, Partner, Energy and Natural Resources, Telecommunications, Media and Technology, Tax at KPMG in Singapore. You stay safe and take care, Mark.
Thank you. Thank you both.
Budget